Hi, hello, good evening. Sorry, I was having a technical challenge in unmuting myself. Okay, so I guess we can start the discussion. It's past 6 p.m. Ladies and gentlemen, I want to welcome you all to this evening's discussion. It is an alumni webinar series by ASPA Professional Institute. ASPA is a registered tuition provider of the Institute of Chartered Accountants Ghana, and they have shown over the years that they do not just care about your success in the ICAG exams, but even after that, they still find ways and means to engage all of us. And that is why this webinar series has been put together to give the alumni the opportunity to engage policymakers and also to make their contributions to the growth and development of Mother Ghana. My name is Al Hassan Yusuf Traore, and I'll be moderating the discussion this evening. But before we delve into the topic, I want to give a very quick word of prayer to usher us into the discussion. Father, Lord, we thank you so much for this evening. Thank you for your gift of life, your gift of grace. Father, as we meet as a team to deliberate on issues that border on the growth and development of Ghana, we pray that you be with us, be with the speaker, be with everyone who has joined the call. We pray that the engagement is going to be beneficial so that at the end, Mother Ghana and indeed humanity will be the best of beneficiaries. This and many other blessings in your name. Amen. All right, so I want to welcome you once again to this evening's discussion. It's important that we look at a topic like this. The topic for the evening's discussion is on tax treaty. It's a topic that has become, as it may, very controversial over the years. We want to discuss the need to review old tax treaties for possible renegotiation. We all know what tax treaties are and the fact that some of them may not inure to the benefit of the country. Yeah, so basically we want to have a discussion on whether there's a need for us to review the old tax treaties for possible renegotiations. Now, to help us do this is a very big man. He's a lawyer, a tax professional with over 13 years experience in finance and tax in the private sector. He's a Big Four and also in public service. He's a member of the Ghana Bar Association, the Institute of Chartered Accountants Ghana, and the Chartered Institute of Taxation Ghana. He holds an MBA in accounting and finance. His current role as a tax audit and controversy specialist with the Ghana Revenue Authority. He previously worked as a manager with Deloitte Ghana and as finance manager with All Seal Services Limited. Ladies and gentlemen, I want to introduce to you Mr. Faisal Mustafa Kontogumbe, Esquire. Good evening, Alhaj.
Good evening, my brother.
I hope you are doing well. Yes.
I'm doing good. Doing good. It's been such, should I say, a good weekend, and this is a special day for us, as I say, given that Ghana is celebrating its 66th Independent Day. So what are we looking out for? What do we look into the future for? What are some of the issues we can bring forth to more or less direct policy in terms of helping Ghana to raise the needed revenue? So basically, as you've introduced the topic, you've hit on the nail, and we're going to have a discourse on this particular topic. It's a very important one. I think everyone will attest to the fact that tax treaties are critical to Ghanaian businesses and also investments into the country, and for which we would need to always be interested in it, and be interested in what are there in these tax treaties for us as a nation and as professionals as well. So basically, our discussion today is going to center on the need for us to review all tax treaties for possible renegotiation. Basically, we are going to discuss that and then if possible provide recommendations as to what needs to be done also make references to other jurisdictions as what happens in other jurisdictions. Are there instances where other jurisdictions have been able to successfully renegotiate their treaties? And to what extent has this benefited them? So without much ado, I would start with the presentation. I would start to share my screen with the slides, and then we would talk to the slides as we present, basically. So just bear with me a second. Let me get the slides on. So I suppose the slide is visible.
Yes,
right?
yes, it is. It is.
Right. Second. Right. So basically, there comes a time where we need to take a look at the treaties that Ghana has signed so far, and to assess to what extent are we driving the relevant benefits that would accrue to these treaties. We will need to always relook at that and then see if there's a need for us to, as it were, renegotiate some, or if possible, terminate some if the cost of keeping these treaties does not more or less inure to our benefits, basically. So basically, that's the key question that we would always need to address. Okay, so these treaties, in both instances, have issues of treaty shopping and a low withholding tax rates, most of it. So you realize that most of Ghana's treaties, most of the old Ghana's treaties, tax treaties, they have issues of treaty shopping provisions and also withholding tax, lower withholding tax rates, which should necessitate the need for review and renegotiation of some of these existing treaties. Research supposes that some other countries, such as Zambia and Uganda, have taken steps to renegotiate their tax treaties, their old tax treaties, and it's been successful. It's been successful. So for us as Ghana, the indication is that there have been steps taken, there have been discussions taken, especially with UK, for possible renegotiation of the Ghana-UK treaty. But I'm not sure it has advanced so far. My checks as of last year suggest that there have been steps. Ghana has tried on a number of occasions to engage the UK to, if possible, to renegotiate the provisions in the tax treaty. But I'm not sure it has advanced to any high level at this stage yet. Basically, Ghana, as a date, has signed about 18 tax treaties. Okay, our 18 tax treaties, has signed 18 tax treaties with or signed tax treaties with 18 sovereign states, right? However, only about 13 of these bilateral tax conventions are currently in force. And the most recent is the Ghana-Morocco tax treaty, which took effect 1st of January of this year. Very interesting. Even though it was signed a few years ago, it took effect 1st of January of this year, 2023. So that means that if any investor who is basically resident in Morocco trying to come down to Ghana to invest, we're looking at what are the benefits in the Ghana-Morocco treaty that it can make use of, it can more or less use or benefit from. If any investor from Ghana so moving to Morocco to invest, we're looking at what are some of the incentives, or what are some of the items in this tax treaty that he or she or the entity can use to its benefits. So basically, Ghana-Morocco treaty is the one on the floor now. It's should I say the new baby in the net, because it took effect just about should I say less than 2 months, about just 1st of January. So basically, countries with which Ghana tax treaties are currently in force are basically they are the United Kingdom. We have the Belgium, Italy, South Africa, Switzerland, Netherlands, France, Germany, Mauritius, Singapore, Denmark, and Czech Republic, and Morocco being the most recent one. It will interest you to know that these tax treaties cover a wide range of areas, basically. And the principal purpose of DTAs or tax treaties is to avoid double taxation, basically. So to ensure that if an entity is resident in Ghana and then going to do business in say Morocco or in South Africa, right? That entity will not be taxed twice in some of its incomes. Okay, so it's to avoid double taxation, basically. And also is to promote the exchange of goods and services. You realize that if the entity gets to know, or the person gets to know that there are these benefits available in these treaties for which the entity can make use of to its advantage, it will surely encourage free movement of goods and services. Okay, to that extent, to a large extent, promote investment. To promote investment. So basically, these are the principal purposes. So it also facilitates. I think the screen is moving fast. So it also facilitates the movement of resources.
You can use the face out. You can use the up and down. You can use the up and down key on your keyboard to move in how you want it.
Right. That's okay. Thank you. So basically, it's meant to also facilitate movements of resources, in terms of capital resources, as well as persons. Okay, and investment as well. And as indicated earlier, it's meant to eliminate double taxation. Said that if a person or a business is intending to come from South Africa to invest in Ghana, right, or to set up an office in Ghana, what are the tax implications? To what extent would the business activity be taxed in Ghana? To what extent would the business activity not be subject to tax in Ghana? Okay, and it helps in minimizing issues of international double taxation, basically. So the DTAs basically, to an extent, restrict economic abilities to tax foreign income. So basically, the essence of that is to prevent double taxation, right, of international income. Because if it doesn't restrict economic ability to tax foreign income, then there's a high likelihood that the income will be taxed in both the resident state and also from the source state. Basically, the resident state being the country of residence of the entity, of the person who's investing in Ghana, basically. And the source state is where the income, the activity takes place. So basically, if a company from let's say the UK, or let's say a company from Switzerland is coming to Ghana to invest, the owners of the business, or where the business itself is resident, okay, it's Switzerland. And where so the activity that generates revenue in Ghana makes Ghana the source state. Okay, so DTAs to an extent seem to restrict economies' ability to tax foreign income in about 3 different ways. Okay, so the first is by lowering the rate of withholding taxes, living on foreign income and as source. So that's why you realize that if a company based in Switzerland, right, comes to Ghana or renders management and services in Ghana, right, the DTA provides a restricted rate, say that you can tax it at this level, okay, to the extent that the beneficial ownership rule is met. You can tax, there's a cap. Okay, so that's and same for dividend, same for royalties. Okay, so the DTAs provide lower withholding tax rates on this foreign income. Okay, so because the entity is maybe resident in Switzerland and earn this income in Ghana because of an activity it has undertaken in Ghana, right? And for which the DTA seem to provide for a lower rate. That if Ghana, you can tax this income which is earned by the non-resident, okay, but you can only tax at this rate. That's one of the key ways the DTA restricts economies from taxing foreign income. Secondly, is by imposing high threshold for permanent establishment. Okay, so our local law, our Income Tax Act provides for permanent establishment. Is that under section? Is this section 110? Just a second, or section 110 or so. Provides for our income tax provides for permanent establishment, and under that, it provides for certain activities. If they span for about 6 months, okay, they should deem to be permanent establishments, okay, for which they should be deemed to be subject to tax in Ghana. However, some of the DTAs, you realize that they have periods spanned up to 9 months. The piece of the DTA state that a PE would only trigger if that activity spans for 9 months. So that means there's an extended threshold. There's an extended time. Okay, so there's an extended time, right, for it to trigger. Okay, our local laws, our Income Tax Act also provides for service permanent establishment. You realize that some of the DTAs do not have, it's clearly stated in that an activity of a service in nature will be deemed as a P as a P. Okay, but our income tax law is clear. But the difficulty is that to the extent that there's a conflict between the DTA and the income tax law, the DTA takes precedence. It's clear, right? So the second way the DTA restricts the economy's ability, especially can restrict Ghana's ability to tax foreign income, is to impose a high threshold for payments for PE. Because if a PE is not triggered, there may not be the need for that entity to account for tax in Ghana, income tax in Ghana. Right? So if the PE is triggered, then it calls for that. So if the DTA provides for a longer span, provides for an extended threshold for PE, then it means that they are limiting the extent to which Ghana or the entity will be subject to tax in Ghana. So that's the second angle, or the second way in which the DTA restricts economies from taxing foreign income, or may restrict Ghana from taxing the foreign income. Finally, or the third way is that tax treaties may simply exempt some types of income earned in the source country. So the tax treaty may state that certain incomes earned from the source state, and the source state is the state in which the income is generated. Okay, some of the treaties may say that this particular income, if earned in Ghana, and we know Ghana, most of it is a source state, most of it than not, but our African countries are the source states, because this is where activity takes place. And then, so we are like the capital important states, right? So we generally generate the money or generate the income, right? And the investors come from somewhere. So the treaty will state that certain incomes, if earned in a source state, should be exempt from tax. Should be exempt from tax. We have set some of these provisions, right? Later on, we will look at one of the key items in one of the treaties, which I think is, for me, is quite troubling. That is clearly states that certain income earned by certain category of persons should be exempt from tax. So these are the three key ways the treaties restrict economic abilities from taxing foreign income, and it applies to Ghana and to a whole lot of the capital important states, or the states that are deemed to be the what? The source states. The screen is not, it's not responding to. It's not responding.
Lavasa, can you please put it in presentation mode? I think that will help rather.
So it is fine.
Yes, I think it will be better from here.
Yes, it's better from here.
Yes.
Okay. So the legal basis of double tax treaties in Ghana. So what are the legal bases? Basically, if someone asks what are the legal bases, to what extent is the tax treaty binding to a member state? What provides the legal backing for a tax treaty? Basically, so tax treaties globally, okay, derive their legal basis or status from the Vienna Convention on Law of Treaties. It's the main law that provides the life spread for treaties, tax treaties. Okay, it provides that every treaty in force is binding upon the parties, and it must be performed by them in good faith. Right? It's not performed by them in good faith. Right. So if to the extent that you are a signatory to a treaty or to the Vienna Convention, right, or the particular treaty, it's binding on you, upon you, and you must perform the provisions of the treaty in good faith. That is a term in law, pacta sunt servanda. That means that you are required to comply with the treaty provisions in good faith. You can more or less want to pick and choose. Okay, and for us in Ghana, Article 75 of the 1992 Constitution of Ghana provides a legal basis for treaties. It's very clear, and I just want to refer to Article 75 of the Constitution of Ghana on the provisions of treaty. It provides that the president may execute or cause to be executed treaties, agreements, or conventions in the name of Ghana, right? A treaty, agreement, or a convention executed or under the authority of the president shall be subject to ratification by what? By the Act of Parliament. Shall be subject to ratification by the Act of Parliament. So upon the president's sign off of the treaty, it needs to be further what? It needs to be further ratified by an Act of Parliament. So the signature of the president alone is not enough. It needs to be ratified by an Act of Parliament. Okay, and or a resolution of Parliament supported by votes of more than 1/2 of the members of Parliament. So you realize that treaty it's not just a minor issue. It carries a weight, carries an economic weight. So the fact that the president has signed off, it needs parliamentary approval because the weight it carries. Right. So you realize that some treaties can be signed off by the president in like 2018, and they will take effect in 2023. because they have to go through these processes for Parliament to approve it before it can take effect. So, for instance, if the treaty was signed off in 2018 and it attained parliamentary approval in, like, say, in October 2022, it will take effect from the 1st of January of the subsequent year, most of it, to the extent that both parties have been able to meet certain requirements for the treaty to take effect. Take effect, most of it, the 1st of January of the subsequent year. So Article 75 of the Constitution of Ghana is clear and provides the legal backing for treaties in Ghana. Termination of treaties. So basically, how are treaties terminated? Basically, how are treaties terminated? These provide that backing, right? So basically, all treaties signed by Ghana continue in force, basically, until they are terminated by either contracting state. So Ghana can decide to terminate the treaty, or the other state can decide to terminate the treaty. Okay, but it continues in force to the extent that it has been signed, and there has not been any steps taken to terminate it. It continues in force. Okay, so in most instances, or the law is that each contracting state desiring to terminate or to cancel a treaty shall communicate its intention to terminate to the other party through the diplomatic mission by giving at least 6 months notice. So if Ghana wants to terminate a treaty, Ghana would have to communicate its intention to what? To terminate the treaty through the diplomatic mission of the other country or the other sovereign states. And you need to give 6 months notice. So you can't just, for one reason or the other, just say, okay, I want to terminate this treaty as soon as possible. No, the country or the state that intends to terminate the particular treaty needs to give 6 months notice to the other party, the other contracting party, or to the other contracting state, that I intend to terminate this treaty with effect from, we are in March now, so with effect from August. 6 months. Or with effect from September, that's 6 months after. At least 6 months notice. Okay, and in practice, usually, this is usually done, or treaties are most often terminated in practice after they have been in force for at least 5 years. That's the practice. So you can't just sign a treaty after 1 or 2 years. You feel like, this treaty is not immune to my benefit. I want to sever it. I want to terminate it. In practice, it most of it should be in force for at least 5 years. So 5 years or more. So the issue surrounding these tax treaties that is necessitating or giving us the call for us to want to direct policy on issues of reviewing our treaties, and also for review our treaties for possible renegotiation is issues of treaty shopping and low withholding tax rates. And what's the origin? What's the origin of these two main hurdles? We're looking at that now. The origin of treaty shopping and low withholding tax rates. So basically, taxation of physical jurisdiction in the traditional market territory relies on one of two principles. Taxation of physical jurisdiction in the traditional market territory relies on one or two principles, or a hybrid of them. And these principles are the source, or the source, principle of the source, or principle of the residence. The source is where the income is generated, right? And the residence, okay, it's where the investment is coming from. So a company coming from South Africa, these mother companies in South Africa trying to invest in certain projects in Ghana here. Ghana is the source because Ghana is the income generating point. And the fact the company has its original home or residence in South Africa is a residence, more or less, state. So basically, taxation of the traditional market territory relies on these two principles, the resident and the source, or a hybrid, or a mixture of the two. Resident or source, a mixture of the two, basically. And you realize that the OECD, okay, and to some extent, even the UN model, okay, favors resident principle. So basically, the OECD and UN model are model tax conventions that are adopted by a lot of nations or Commonwealth countries, right? So most of the OECD and even to an extent the UN model, they favor the resident principle. That means that it goes to the benefit of the resident, the resident entity or the resident person. So if Ghana and US South Africa has a DTA or sign a DTA, you realize that the country from which the investment is coming from, okay, the treaty provisions would always favor, in most instances, favor those countries. Right? Most instances favor those countries. Okay. And DTAs most often shift the taxing rights from the source state, right? Like Ghana be the source state, for instance, or Ghana can be the more or less the residency, depends. But in most instances, we have Ghana here be the source state. So the DTA can shift the taxing right from the source state, that's the capital importing country, because we are receiving the capital, we are receiving the investment. So DTA will shift the taxing right from the source country, that's the capital importing country, to the resident state, that's the capital exporting country, that's the country from which the investment is coming from. So because of these three key issues, okay, these three key issues provide the origin for treaty shopping and low withholding tax rates. Right, they provide the basis for treaty shopping and low withholding tax rates. So we now move on to issues of limitation of benefit provisions in Ghana's tax treaties. Okay, so the LOB provision seem to resonate with issues of treaty shopping. Okay, it tries to curb treaty shopping. Okay, it tries to minimize the extent of treaty shopping. So basically, treaty shopping is where two entities or businesses try to exploit certain provision of the treaty, or try to take advantage of certain provision of the treaty by structuring their businesses or by arranging their transactions, said that they can exploit the treaty benefits, even though, or normally, or even though they are not supposed to enjoy, but they structure their activities to exploit treaty benefits. And these LOA provisions are meant to take care of those ones, are meant to curb treaty shopping. Right? Section 98 of our Revenue Administration Act, okay, Act 915, provides a general limitation of benefit rule. Very critical. Okay, so Section 98 of our RA provides a general limitation of benefit act for businesses and transactions in respect of treaties. I just want to refer to that. So Section 98 of the RA 915, Section 98.5 provides that where an international arrangement requires Ghana to exempt an amount from tax or subject an amount to reduced taxation, the exemption from or reduction of tax is not available to an entity that, A, for the purpose of the arrangement, is resident of another contracting state. So basically what it seems to state is that if a treaty or international arrangement provides for a lower withholding tax rate or provide for an exemption from tax, okay, for a particular entity, okay, that exemption shall not be available, okay, shall not be available if the entity who intends to enjoy this benefit is not a resident of the other party. So, for instance, Ghana and South Africa has a DTA, and a company based in, let's say, India, realized that because of Ghana and South Africa DTA, if they pass their investments through South Africa into Ghana to show that the business is coming from South Africa, every service they render in Ghana will be subject to tax at a lower withholding tax rate. So ideally, for instance, if a company based in India provides services, management services to a company in Ghana, right? Because there is no DTA, the withholding tax on that is about 20% or so. And the company knows that if it loses its transaction through South Africa, which has a DTA in Ghana, to show that as it were that particular company has its route in South Africa, then it can take advantage of the treaty for it to be subject to tax at a lower rate, as low as 5 or 8%. Right? So it would want to take advantage of that. And that's what this treaty, this provision is trying to eliminate, to prevent. Because it says that the entity the entity can only benefit to the extent that it's resident of the other contracting state. If you're not resident, then you can't enjoy the treaty benefits. And B says that, and so he said that the end means they must go together. The end means these two provisions must go together. And 50% or more of whose underlying ownership is held by persons who, for the purpose of the arrangement, are not residents of other contracting states. So if the entity is coming from India and is trying to route its transaction to South Africa, the law says that to the extent that the company which more or less pretends or tries to say it's from South Africa, is underlying ownership, 50% of it should be owned by persons who are resident in South Africa, and not just a company. Not just that someone who is resident in India goes set up a company in South Africa, okay, set up a company in South Africa and owns like 80% and gives the South African 20%. So that means that the underlying ownership in South Africa is only 20%, and for which that entity cannot enjoy the treaty benefit. The entity can only enjoy the treaty benefit if the underlying ownership is owned by persons who are underlying ownership of 50% or more, okay, or underlying ownership of 50% or more is owned by persons who are resident in South Africa. So Section 98 of Act 915 is clear on that. Okay, but the question is, to what extent can Section 98 bite? Because it is clear the same RA provides that, or the same law provides that, to the extent that the treaty provisions conflict with your local law, the treaty provisions override the local law. Then we move on to the other side of limitation of benefit provisions. In most of Ghana's old tax treaties, okay, limitation of benefit provisions are restricted to only certain items. Okay, they are restricted to only dividends, interest, royalties, and management services. We don't have an omnibus limitation of benefit provisions in most of Ghana's tax treaties, especially the old ones. We don't have an omnibus limitation of benefit provisions, which is a difficulty. I read that in recent times, most of our treaties now, they try to bring in omnibus LOB provision or limitation of benefit provisions, which we didn't have, which is a difficulty. So you realize that in the old treaties, the LOB or the limitation of benefit provisions are limited to only dividends, interest, and royalties. So you realize that under the treaties, under I'm trying to open one of the DTAs. And under the treaties, there are a number of items, okay? Items, I'm trying to get the exact words. That there are a number of clauses or items, okay, for which the DTA more or less considers, okay, and the DTA considers a number of articles, okay, and for most of Ghana's old tax treaties, the limitation of benefit provisions are limited to only dividends, interest, royalties, and management services. So that means that someone can actually exploit or treaty shop under the P provisions if there's no LOB provision or if there's no limitation of benefit provision. I have just opened Ghana UK tax treaty, and there's nowhere, I've not seen anywhere in the tax treaty, in that particular tax treaty that you have, that you seem to have an omnibus LOB provision or an omnibus limitation of benefit provision. Meanwhile, we have a lot of articles that borders on income tax. Okay, under Ghana UK tax treaty, article 4 borders on P, permanent establishment. Article 5 rather borders on P, permanent establishment. And under permanent establishment, I don't see anything about limitation of benefits. Anything that seems to say that you can only enjoy some of these benefits under this if you are underlying ownership or the entity underlying ownership of 50% or more is resident of the other contracting state. I don't see that under P and the permanent establishment under Article 5 of the Ghana UK Treaty. I don't see that under Article 6. I don't see LOB under Article 7. I don't see under Article 8. Where I see is Article 10 which goes for dividends. Okay, and under Article, so I'm going to read under Article 10.4 says that the provisions of paragraph 1 and 2 of this article shall not apply if the beneficial owner of the dividends, being resident of a contracting state, carries on business in the other contracting state of which the company paying the dividends is resident through a P. Okay, so you realize that the limitation of benefit provisions only applies to dividends, interest, which is Article 11, and also management fees or royalties, which is Article 12. But we don't have an omnibus LOB or limitation of benefit provision. So that means that persons or entities can treaty shop under the other articles. And that's a concern. But like I said, in most of the recent treaties, in very recent treaties, I realized that they are into this omnibus LOB or limitation of benefit provision. So the omnibus ones will take care of all the articles and not to restrict to specific articles. Then we move on to the other major issue, which is issue of low withholding tax rates in Ghana's tax treaties. You realize that most of Ghana's tax treaties have low withholding tax rates. Okay, so the tax treaties they set maximum rates at which withholding tax can be levied on cross-border payments or transactions. Okay, so specifically dividends, interest, royalties, management or service fees. The treaty states that to the extent that one or two conditions are met, you can only tax at the maximum of this rate. At the maximum of this rate. So there's a cap. However, our Income Tax Act, which is Act 896, as amended, provides for withholding tax rate for certain items. And you may even be surprised that certain items may be tried to higher withholding tax even in Ghana than what's in the treaties. So that means that if a local entity provides some of these services, they may be tried to higher tax rate than if someone from South Africa or the UK provide that service in Ghana. So, for instance, Act 896 provides that withholding tax on dividends is 8%, interest is 8%, to royalties 15%, management and internal service, if performed by non-resident, is at 20%. Okay, where if performed by Ghanaian entities is 7.5%. However, we'll look at the table below, However, the table below, the DTA provides lower rates. Just take note of the rates that we have here for some of these items. Dividend 8%, interest 8%, royalties 15%, management and internal service fees performed by non-resident 20%. That's where there's no DTA. And performed by if management service performed by a resident entity, is taxed at 7.5%. But you realize that some of the treaties have lower rates for some of these services, for some of these items. And that's a concern. Okay, and all these rates, should I say, raise concern as to the kind of income or revenue that's forgone by the state as a result of this reduced withholding tax rates on dividends, management services, and interest as provided for by the treaties. And that's the concern. So these are the rates for some of the treaties. I think that Morocco treaty is not here, but it had a full complement of the other treaties. Ghana, it says 8% on dividends. If a local entity if a local entity paid dividend to its shareholders, it tax at 8%. If you see here, under Ghana, France, DTA, how much is this? 7.5%. UK 7.5%. Belgium 5%. Italy 5%. Dividends. Singapore 7%. Mauritius 7%. That's if the LOB provision is met. If you see the dividend where the resident holds 10% or more of the shares, 7.5%. In another case, 15%. See royalties. In Ghana, pay the rates. Royalties is supposed to tax at 15%. Isn't that the case? Royalties, you tax at 15% per local law. So if a Ghanaian entity is paying royalties to another Ghanaian entity, supposed to tax at what? 15%. Let's come back to this table. What are the rates for royalties for France? 12.5%. UK 12.5%. Belgium 8%. Italy 10%. Germany 8%. Compared to the 15% in the Act, which other companies are paid, which other local entities are paid. See management and interior services. France 10%. UK 10%. Belgium 8%. Italy 10%. And see management services. If it's provided by non-residents who have no DTA, it's 20% in Ghana. In any other case, provided by Ghanaian resident entities is tax about 7.5%, which I think is on the lower side, right? Apart from Singapore, which is 7%. So you can just see, at least if this were 50-50%, it would have made it would have helped in a way. So you can imagine this rate and compare that to the extent of revenue that we are losing because of this reduced rates. That's a difficult. This is one of the key items that is of very interest to me. In the Ghana-Switzerland Tax Treaty under Article 12.4, very interesting. Article 12.4 of the Ghana-Switzerland DTA provides that the purpose of withholding tax on royalties and money and services, it provides that if a non-resident entity other than an individual from Switzerland provides services in Ghana, such services shall not be subject to tax, shall not be subject to withholding tax in Ghana. So if a non-resident entity from Switzerland, other than an individual, provides services in Ghana, such services shall not be subject to tax in Ghana. So that means that it's only individual from Switzerland. When they provide services in Ghana, they have tax in Ghana, withholding tax in Ghana. If it's an entity, it should be exempt from tax. To what extent do we have individuals from Switzerland coming to provide services in Ghana? In most instances, it's companies. In most instances, it's companies that provide services. So if this DTA sought to exempt companies who provide services in Ghana from withholding tax, then to what extent would we be getting revenues or new revenues from such entities? We are losing. Very, very key. Just look at, just find time and read this provision under the Ghana Switzerland DTA, Article 12.4. Just try it. I'm just trying to open it. Article 12.4, Ghana Switzerland DTA. Try to open that and read that for us to get what the reason is. It's very interesting. And so you ask yourself, to what extent do we have individuals from Switzerland who provide services in Ghana? We only have entities. We don't have entities. We don't have individuals. We don't have individuals. What I have is a French version. But you can always check. Article 12.4 of the Ghana Switzerland DTA states that if an entity from Switzerland, other than an individual, provides services in Ghana, it should not be subject to tax. Then move on to the other area or other issue which also leads to loss of revenue, or which also requires us to rethink or review our treaties. Issues of P, the P provisions in Ghana's tax treaties. Very, very key. Permanent establishment. P. So permanent establishment looks at the activity. To what extent would an activity be deemed to have a tax base in Ghana or tax measures in Ghana? To what extent would an activity would be deemed to have created a tax presence in Ghana? That's what basically it talks about. And the provisions on PE in most of Ghana's tax treaties generally provide for a fixed term of business through which the business of an enterprise is wholly or partly carried out. A fixed place for a business of an enterprise or a person is partly or wholly carried out. Except for Ghana, Mauritius, and Ghana Singapore treaties. It is for these two treaties, we don't have this clear provision. It doesn't state that there should be a fixed term of business. But all the other treaties, it states that there might be a fixed term of business. We know, and we know. There are instances where people do business in Ghana yet without any fiscal or without any fiscal period or without any fixed term. Okay, so yeah, that it's only Ghana and Mauritius, and Ghana Singapore treaty, and these ones are the most recent treaties. They are very recent treaties. The old treaties do not. Old treaties provide for fixed term of business, but the recent ones, which is Ghana, Mauritius, and Ghana Singapore, they don't have those ones. So those ones, like I said, we are going to realize that okay, the ones we signed, these are the issues in it, and we are making progress. They are making sure they incorporate those deficiencies. They make sure they don't repeat those issues. They don't repeat those deficiencies in the subsequent treaties. So what are we doing about the old ones? They're already in force. Are they not able for us to go and have discussions on possible negotiation, to review them holistically, to say, we have seen this and this and this for this number of years. The treaty have been enforced. Can't we relook at them and renegotiate some of the terms? The Ghana-Netherlands Treaty and the Ghana-Switzerland Treaty, the Ghana-Denmark and Ghana-Germany Treaty, Ghana Sessions Public Treaty 2, further provides for construction permanent establishment. Construction. And that is building, assembly, installation, or supervised activity to constitute permanent establishment. Only if it lasts for more than 9 months. You realize that, and one of the key ways that the DTAs restrict economic taxing right on foreign income is to provide for extended permanent establishment rules or enhanced permanent establishment rules. And this is one of it. 9 months. Why 9 months? And not 6 months, and not 5 months. So see, the Ghana-Netherlands Treaty, Ghana-Switzerland, Ghana-Switzerland Treaty, Ghana-Denmark Treaty, Ghana-Germany Treaty, and the Ghana Sessions Public Treaties further provides for construction PE. And it states that it is for building, assembly, installation, supervisory activities. For this to constitute as PE, only constitutes as PE only if it lasts for more than 9 months. Why not 6 months? So there's an enhanced requirement for PE to be triggered. Meanwhile, we know that most of the treaties that we see, most of even our local laws and the PE, it's almost often talks about 6 months. Most of it 6 months. Most of it is around 6 months. But here you have 9 months for construction PE for these treaties. So that means that someone can come in, do 6, 7 months construction and move. Do 8 months and move. Do 9 months and move. But it lasts for more than 9 months. So anything below 9 months means there's no PE. PE will not be triggered for construction activity. If someone comes from any of these countries, these are the difficulties. These are the difficulties. I'm just going to open one of them, Ghana-Netherlands Treaty, on that construction PE team, and read for us to have it live, have a live feel of it. So these have been the major good. So under Ghana Netherlands Treaty, Article 5.3a provides that Ghana Netherlands Treaty provides a building site, a construction, assembly or installation project or supervisory activity. Okay. So under Article 5.3, let me start with 5.3. It said that the term permanent establishment likewise encompasses A, that's 5.3a, a building site, a construction, assembly, installation, project, or supervisory activity in connection therewith, but only where such sites, projects, or activities continue for a period of more than 9 months. Where only such site, project, or activities continue for a period of more than 9 months. That's what I'm talking about. This is a Ghana Netherlands Treaty. I've just read Article 5.3. And same for Ghana Switzerland, same for Ghana Denmark, same for. So if someone comes here, the person can say, okay, I'm from Denmark or I'm from Switzerland. Let me do 7 months construction or assembly or installation and move, and there will not be a P. Because though our local law may say 6 months, the treaty provisions override our local law. So, like I said, our Ghana laws, most of it. However, Ghana's other tax treaties, there are other ones, as apart from the ones I've mentioned earlier, apart from the Ghana, Netherlands, Ghana, Switzerland, Ghana, Denmark, Ghana, Germany, Ghana, Czech Republic. The other tax treaties provide for 183 days or 6 months to trigger that, which is at least for me that appears a bit good for me. 6 months, 183 days, trigger P, that's okay. But something beyond that, 9 months for reconstruction, it doesn't sound good, and it requires us to look at that and possibly to re-engage other parties for possible negotiation. Section 110 of Ghana's Income Tax Act, okay, also provides for Section 110 of Ghana's Income Tax Act also provides for service permanent establishment. Okay, so basically, our Income Tax Act 896 provides for services permanent establishment and requires for at least a period of 6 months to trigger a P for services. Okay, and this is in conflict with most of Ghana's tax treaties, because you realize that most of Ghana's tax treaties do not have service P. Do not have service P provisions, and to the extent that these treaties do not have not clearly stated that a service for this period constitutes P, it has let it out. So under which law will you tax it? Would it be under our Ghana laws, for which it is clear that where there is conflict with Ghana laws, where the treaty conflicts with Ghana laws, the treaty prevails. The treaty is silent on service P, and the Ghana law says tax it. What do we do? So apart from Ghana Czech Republic and Ghana Singapore DTA, which are recent ones, like I always say, they are recent ones. They are the ones that I've seen that they have provisions for service P in the DTA. The Ghana Netherlands, the Ghana Czech Republic, and Ghana Singapore. They have service P. However, for the other ones, if you look at Ghana UK or Ghana Netherlands DTA, you don't have anything that talks about service. You see assembly, installation, supervisory activities. You don't see anything that talks about service. So does that mean that if anyone from that country comes to provide certain services, P may not trigger? That's difficult, and that calls for us to review this and to see if we can further engage the major stakeholders for review. So basically, we have what we call the OECD multilateral convention to implement tax treaty related measures to prevent base erosion and profit shifting, BEPS Action 7. Okay, so this is mainly to curb issues of treaty shopping, to prevent what we call base erosion and profit shifting, basically. Ensure that entities do not scheme transactions to erode their tax base and to shift profit from one jurisdiction to the other, just to take advantage of the tax burden or to minimize their tax liabilities. Okay, so basically, tax treaties generally provide that business profit of a foreign entity are taxable in a jurisdiction only to the extent that the enterprise in that jurisdiction has a P to which the profit is attributed. So you see where we are coming back. So generally, tax treaties provide that you only tax an enterprise business profit. Okay, if a foreign enterprise, only if it has a P in Ghana. So if the construction side, that construction business that we looked at under Ghana Netherlands Treaty, they come and do a construction for 7 months or installation for 7 months. And the treaty says that because they spent less than 9 months, there's no P. So that means that you can't tax their business profit in Ghana. Is that what is that the case? You were the end business income. Because they spent less than 9 months, it can be taxed. And the OECD Montreal Convention to implement tax treaty related measures, BEPS Action 7, is meant to take care of some of these things. A lot of countries have signed on to it. So far, about after the last time I checked, that was some few days ago, on the 4th of March. When I checked from the database, globally about 100 countries have signed. And as of 21st February 2023, Ghana was not yet a signatory to this convention. And this convention is meant to implement treaty-related measures to prevent base erosion and profit shifting. Ghana has still not signed onto it. Other countries in Africa have signed. Other countries have signed. Globally, about 100 countries. Other countries have signed. I can get you the number of countries that have signed in Africa. Thirteen African countries have signed. Globally, 100 countries, 13 African countries have signed as of 21st of February 2023. This convention is meant to prevent base erosion and profit shifting. 13 African countries have signed, and 100 countries globally. Ghana hasn't signed yet. These countries are Burkina Faso, Cameroon, Cote d'Ivoire, Egypt, Gabon, Kenya, Mauritius, Morocco, our big brother Nigeria, Senegal, Lesotho, South Africa, and Tunisia. These countries have signed to the OECD Montreal Convention to implement tax treaty-related measures to prevent base erosion and profit shifting. BEPS Action 7. 13 African countries have signed. 100 globally. Ghana, as of 21st February, has still not signed. It's a concern. So if you've not signed, that means you are not bound by it. And you can't derive the benefit that comes with it. So after speaking around all these issues, what are the recommendations? What is the way forward? What can be done? What are the initiatives or what are the proposals for policymakers to look into? Because based on what we discussed, you can just do your imaginary calculations on the revenue that is being lost. Yeah, so some of the recommendations that we have are one, to conduct stakeholder consultation based on draft negotiation text. So if you are to negotiate future treaties, at least consult other stakeholders, business, the AGI, tax professionals, financial specialists, and other people who matter on the draft agreement that you have to sign before you sign it, before they are executed. Okay, and we need to reconsider treaties that most restrict the tax rights of Ghana. There are quite a number of them. Like I mentioned to you one of the provisions under the Ghana-Switzerland Treaty under Article 12.4. It restricts Ghana from taxing certain services performed by non-resident entities from Switzerland. And to introduce a general limitation of benefits provision to apply to all the articles for all future bilateral tax treaties. Like I said, I've realized that in most of the recent tax treaties, you can see omnibus LOB provisions, omnibus limitation of benefit provisions. We have to ensure that we keep that. All our future tax treaties, we have to ensure that we have omnibus limitation of benefit provisions. That means that the limitation of benefit provisions should apply to all the articles and not only selected articles. And 3, we need to identify the areas where a tax treaty and domestic law leave it most vulnerable to revenue loss. So the gaps in the treaty and domestic law. Right. And like I said earlier, we realize that the issue of PE, for some of the treaties, they provide for construction. We look at Ghana and Netherlands. It provided for 9 months. At 896, in any case, we provide for 6 months. So you see the gap, that there's a 3-month lag here. How do we address that? Meanwhile, the treaty takes precedence of our local law. It takes precedence of our local law. And the 4th and the most important recommendation is to request for treaties that have the general actual, the greater actual cost, or that request for all treaties. Request for renegotiation of the old treaties. You need to request for a review, a renegotiation. And first of all, let's review them, look at them in the space of the current economic situation. To what extent are we benefiting? The numbers are there. Are we really getting the investment inflows? Are we getting avenues for them to come in, invest, and take the same money out through some of these channels? So we need to review them, see where the gaps are, then request for renegotiation of those gaps. If it's on issue, if we are requesting for renegotiation of one of both the key things are on the limitation of benefit provisions, permanent establishment provision, and the withholding taxes. So we are going to request for the for them to negotiate that for the old treaties, we want an omnibus LOB provision, an omnibus limitation of benefit provision to take care of all the articles. We need to request that, or we need to request that the PE provisions should cover services for all the old treaties, and it should be for a period of 6 months and more, and not for all, and not for some. You see some 9 months for construction. And the withholding taxes, we looked at some. Even dividends. If a local company pays dividend in Ghana, it's taxed higher than if a non-resident. It's higher than the DTA ones. Some of the DTAs have 7%, some 5% for dividend withholding tax. Meanwhile, if the Ghanaian company pays dividend, it starts at 8%. We look at royalties too. The Ghanaian pays royalties. Another Ghanaian here, it can pay as high as 50% in royalties. Meanwhile, when same royalties is done for the purpose of DTA, it's a lower rate. It's very low. So basically, these are the recommendations that we have for for policymakers to look into and to see the need, because these are crucial times that the economy is in dire need of tax revenue more than ever. And we all have to, in one way or the other, provide options or make suggestions and see how we can drive policy to as it were, look at some of these avenues that may help improve the revenue generation in one way or the other.
All right. Thank you very much, Council, for that very detailed presentation. Indeed, it's been a learning experience. Almost all of us have learned and taken some lessons from the presentations you have made. So we'll want to open the floor now. Now, if you have a question, you may want to either raise your digital hand so that we invite you to speak. Alternatively, you can type in your question in the Q&A session, and then we invite you to speak, or we read out your question for Council to respond to it appropriately. Indeed, the presentation was quite apt. He ended by giving us some 4 recommendations: stakeholder consultations, limitations of benefit provisions, domestic legislation, as well as the most important one he mentions, that is renegotiation of the old treaties. So with that said, I think there are a few hands up already. We are going to allow them to speak. I'll start with Nokia 2.4. I don't know who is using that, but you can unmute now and then ask your question. Nokia 2.4, yes.
That's Joshua.
Joshua, okay, Josh, please go ahead.
Yeah. I want to find out from Lawyer Faisal that what is the position of the Constitution 1992 regarding tax regime of today? Because I know the Constitution in the Supreme Book, so I want to pick it from there before I ask my follow-up question.
All right, Council, maybe you want to briefly speak to that. As I remember at the beginning of the presentation, he made mention of some provision in the Constitution which allows treaties to be entered into by the President on behalf of the country. But Council, please speak to it. Thank you.
Okay, so Joshua, if I get your question right, you want to know what the general
position of the 1992 Constitution with regards to the tax regime, not a treaty.
Okay. So basically, I would have to bet there's an article in the Constitution that provides for the tax regime. Okay, that requires that persons are required to pay the legitimate taxes that are due to the economy or to the state to help the state raise the needed funds. If in the Constitution we have that article, I have to check that. I'm checking that. There is clear, we have that in the Constitution that requires persons, individuals or entities to pay the right taxes to help the economy or the state raise the needed tax revenue. So it's in there. There's no doubt. The Constitution provides that basis.
Okay. All right. The reason why I'm asking is that because of the treaty between Ghana and Holland, right? Or Switzerland?
Okay, Switzerland.
Switzerland.
Yes.
Is it Switzerland or Holland?
No, there are a lot of them. So which one?
I mean the treaty between Ghana and Holland. Yes, Holland.
Okay. Okay.
Yes, you may mention that they can come and work here for 9 months without any tax payment.
Okay, that's the construction fee. The construction fee,
yes. Yes. So in this regard, as it's a treaty, it means that it cannot be reviewed by Parliament. Parliament cannot amend that part of the tax law.
No, so the treaty is why not? You can even terminate it. You can.
But when the two conflict, the treaty stands
Yes, I've mentioned that. When the two conflict, the treaty overrides.
The treaty overrides it.
And we also have the option to renegotiate or to even terminate the treaties.
Now, okay.
Yeah,
okay.
so your question again, under Article 174 of the Constitution, provides for taxation. And under Article 174(1), it says that no such taxation shall be imposed otherwise than by or under the authority of an act of parliament. So that's why any act that imposes tax will be an act of parliament. You can't just pass a subsidiary law to impose tax. That's why Act 896 is a major one on income tax. If you look at the VAT 2 is an so all the laws that impose tax are acts of parliament. And Article 174(2) says that where an act enacted in accordance with clause 1 of this article confers power on any person for it to waive or vary a tax imposed by that act, the exercise of the power of waiver or variation in favor of any person or authority shall be subject to the prior approval of Parliament by resolution. So you see this. Subject to the prior approval, where there's a waiver, where there's a requirement for a waiver, it is Parliament approval. That means the tax is a critical component. That you can't, no one can just sit down and waive tax. It needs
First, I think that point has been made. There are a number of other questions. We may want to move on to the others.
Right.
So thank you very much. I have a question here by Samuel Ej Annan. He's asking, does Ghana have a tax treaty with Nigeria? I'm not sure I saw it.
No, no, we don't have one. You know, when we started, I indicated that we had about Ghana has signed about 18 tax treaties. We can have 13 in effect now or in force. With the most recent one being Ghana, Morocco.
Okay.
In Africa, we have only two or three. It is Ghana, Morocco, Ghana, South Africa, and Ghana, Mauritius or so.
Okay. That's well noted. Yeah. Thank you. So Obu Richard is also asking, DTAs are bilateral agreement with benefits to each country. The analysis has been skewed as if it's a one-way affair. Do we know the benefit that Ghanaian persons as individuals and firms get from DTA? Or is it the case that Ghana has failed to export firm and services to these countries for benefit, hence this approach? I don't know if you get a question. He's saying that the presentation has been skewed as if there are no benefits.
We don't rule out. You know, when we started, we indicated the principal purpose of DTA is to ensure movement of goods and services and ensure investment flow, right? So the numbers are there to speak to, yes. So we're looking at that, but all the same, we're looking at the area that we think we can work on it to improve and to improve our revenue generation as a nation. We're looking at both sides, and it should be a win-win. It should be a win-win. So it's neither here or there. DTA has its positive benefit, positive impact in terms of investment flow. But to that extent, we still need to get the right pie, the right part of the cake. We don't need to lose on the angle, despite the fact that we are getting the needed investment.
All right, thank you very much.
Right part.
I think Richard has taken note of that. Samuel Kwabena Intifo, please, you can unmute and ask your question. Sammy.
All right, thank you very much, moderator, and thank you very much, lawyer, for the wonderful presentation. Lawyer, in fact, you have emphasized about 2 or 3 times that when double taxation agreement conflicts with the laws of Ghana, the double taxation agreement take precedence. My question is, to what extent? I'm asking because what if the double taxation agreement, which is taking precedence, is going contrary to the laws of Ghana? So I want to know to the extent to which the DTA take effect. And secondly, it seems I overheard in the news that Ghana and Turkey has finalized the double taxation agreement treaty. So I don't know whether I want to confirm whether something of that sort is there, or so Ghana has no agreement with Turkey. Thank you.
Okay. Thank you. So I think it's clear. I think it is clearly. I've even reiterated that the law is clear on the position of the treaty to the extent that there's a conflict with the local laws. It says the treaty provisions override. So I don't anticipate where the conflict leads to a serious violation of our laws. Most often, it is borders on taxing rights. Most of the conflict border on taxing rights, and that's why I indicated that the treaties, in some instances, provide for 9 months for an activity to constitute as a P. However, our local law says 6 months. So you see where the conflict is. The treaty overrides. So most of it, you don't see, this violation is not that serious, but most of it is borders on taxing rights. And if that happens, treaty provisions prevail. So I'm not sure Ghana would approve a treaty that would have serious violations to our laws. Most of it borders on taxing rights, basically. And the income tax treaty borders on taxation of income, basically. And on the other one, the Ghana Turkey DTA. So most of it, the DTA can be signed. Okay, it can be signed off, but it might not receive parliamentary approval. It only takes effect when it receives parliamentary approval. And if at any point in time it receives parliamentary approval during the year, the practice is that it takes effect 1st January of the succeeding year. You see, so the Ghana Turkey one, I'm not very sure if it has parliamentary approval. The one I know about is the Ghana Morocco one, which I said received parliamentary approval somewhere latter part of last year. It took effect 1st of January this year. So the Ghana Turkey one, I can check. I'm not sure. I can check and see if it has received parliamentary blessings for which it will take effect. I'm not very sure of that.
All right. Thank you very much. So Amos is asking, if Ghana wants to terminate a treaty, does it need parliament approval? If Ghana wants to terminate a treaty, does it need parliamentary approval?
To the extent it may. I would have to check that. I'm not very sure of it. I'm not very sure of that position. But to the extent that it needs parliamentary approval for it to take effect, it may also need that for it to be terminated, basically. But like I said, you need to give 6 months notice of your intention to terminate through the diplomatic mission of the other country, of the other states, right? I think I'll have to check that, but I think you may also need parliamentary approval. The extent that when it was coming into law, you needed that. If you are going to cancel it, you need that approval as well. I'll have to check that, but I think you should.
All right.
But they made a law, and they should have the right to terminate it.
Okay, thank you very much. So Kingsley, please, you've unmuted. Kindly go ahead with your question. Kingsley Holanogbe.
Yes, thank you very much. With regards to service PE, which is not in older agreements, is it not the case that if we don't have it in the agreement, then the local laws will apply?
This is a very good question. So if you don't have it in agreement, okay, doesn't that mean that there's no provision for it, for which if there's a service activity here, P will not come in, P will not be triggered?
I think is it really a conflict? I think that once that provision is not made, then the tax law in Ghana will apply, and the provision in the tax law is how to now be applied It is when there are, it also, the agreement also has it in it. That is when the agreement will take precedence over the local law. But then where there is nothing in the agreement like that, then the local law will take it up from there.
Because the other difficulty, the agreement provides which activity constitutes permanent establishment. It provides that. Okay. And if it provides which activity constitutes permanent, and it doesn't make it clear that services is part of those items, I see it to be a conflict.
Okay, thank you.
All right, thank you. So one anonymous attendee is asking, if Parliament decides to terminate those tax treaties, what will be the implications on Ghana? If Parliament decides to terminate tax treaties, what will be the implications on Ghana?
Okay, right. So I'm not sure. We are looking at our Parliament terminating the treaties. I'm not sure that would be the way to go. What we are looking at is to see if they can engage the other parties for renegotiation of some of the provisions. Okay, but terminating them will not be the right option. If that happens, we may be losing quite substantial foreign direct investment, another investment that may flow, because entities or businesses come into the country because the treaty provisions, because the treaty benefits that they would derive, for which if they are cancelled or the treaties are terminated, they may be reluctant to come in because they feel they will not have anything to cushion them. So we may be losing a lot in terms of investments inflow into the country, right? But like I said, the focus is to see if they can re-engage them for renegotiation and not merely to terminate these treaties.
Okay, thank you. Integrity, please unmute and ask your question. Integrity. I don't know who is using that.
Evening.
Good evening. Kindly introduce yourself and go ahead, please.
Yeah, just want to thank the facilitator. And I want to also find out, like you suggested, if we actually want to review the treaties, like the fourth one that he mentioned, will there be anything that we'll be losing? Because I know when they were signing the treaties, there were actually Ghanaians who were level-headed that looked at it and then they signed it. And to sign a treaty where you just see clearly that there's a very serious defect in Ghana, probably something might have happened. And so if there's a reason why those treaties were signed that way, and if we should review them, what are we going to lose?
Okay, so, I indicated in the submission that the most recent treaties, you realize that they are making changes, they're taking care of some of the loopholes. These are old treaties, and at the point that they were signed them, they might not have affected their mind certain things. But as time went on, and as reality dawned on us, some of these things came up, and then they will reflect on them. Okay, it doesn't mean that people, they thought true. But some of the things, until you practicalize it, you wouldn't really feel the effect. Okay, so that informs why the most recent treaties, they are taking care of some of these things, right? Especially the permanent establishment provision for services, and also the LOB omnibus LOB provision. They are there. So it's something that, like I said, you only feel the effect when you practicalize it. Okay, but at that point, people did it in good faith. Okay, in good faith. Not to say they did it in good faith and they were level-headed. But some of these things would only iron out when you practicalize it. And then it informs why the most recent treaties, they are considering these issues, okay, and making sure they're taken care of. So we are saying, okay, the old treaties, what do we do about those ones? Can't we renegotiate? Given that the new ones, we are considering this then the old ones, let's look at engaging the other parts for renegotiation. So they did it in good faith. Yes, that practical practicalizing it has brought up the issues, which they've even seen, and they are considering that in the subsequent or the most recent treaties.
All right, thank you very much. Faisal, please unmute and ask your question. Faisal. Faisal. So we are reminded.
Hello.
Yes, kindly ask your question or make your
Yeah, good evening.
Good evening.
Oh, thank you so very much for the, in fact, for the slides that you have given us. In fact, I joined the Zoom very late, but I really enjoyed the lecture, and I would like to commend him for the good work done. He should continue. It's not a question anyway. I'm just commending him for the good work, and he should continue doing that to educate and enlighten us on the tax issue. Thank you so very much.
Thank you very much, Faisal, for those words of encouragement. Indeed, we join you in appreciating the work that has been done this evening by our facilitator. We are reminded that the slides will be shared for all of us to benefit from the knowledge that has been shared. So thank you very much, Faisal.
Thank you too.
So the floor is still open. We have some 5-10 minutes. If anybody has a question, please do well to ask. But in the meantime, we are reminded that ASPA's Chartered Institute of Taxation program for August 2023 sitting is starting on 25th March. Please enroll if you want to write in the August sitting. Join the team of experienced professionals as they take you through the preparatory stages for the examinations. So it appears all your questions have been exhausted. The lecture has gone on well with everyone. So maybe, Mr. Faisal, you may want to give your final remarks if there are any, and then we take it from there.
Okay. So basically, just to conclude, this session is just meant for us to share research knowledge that we have done, carried out, and then to see how we can get others to be on the same page with us. And sure, the discussions will continue even from here. Available for further discussion or further discourse. If anyone has any questions, feel free to reach out. And like as I mentioned, ASPA is an institute that takes students through practical sessions, tutorial sessions for the ICA, CIT exams as well. And we encourage all interested persons to join us. It's always a session meant for us to discuss and share ideas, people with practical perspectives, share ideas with us, for us to help develop and help grow the accounting and tax profession in Ghana to an admirable level. So for now, I would say thank you for making your time to join this session, and let's keep the conversation going. Should not end here, right?
All right. Thank you very much, Faisal. Ladies and gentlemen, this evening the discussion has been on the need to review the old tax treaties for possible renegotiations. The facilitator for the Alumini webinar series has been Faisal Mustafa Kontogumbe, and he's done justice to the topic. So until we come your way again with another Alumni webinar series from ASPA Professional Consults, we want to thank you very much for making time this evening to be with us. Once again, the CIT for August 2023 registration is currently ongoing. Join the team and enjoy many of such discussions. We thank you for your time. Thank you to the facilitator for giving us a wonderful piece of information that will help all of us in our dealings, and also for policy makers to take a cue or to get some insight into what some modern tax professionals think about our tax treaties. So thank you to all of us for making time once again. Until we meet again next time. My name is Al Hassan Yusuf Traore, and I was your moderator for the program. Bye-bye for now.
Bye for now.
Thank you. Bye. I really enjoyed it.
Bye-bye. Any updates on graduation?
Which of the graduations?
It is in my sitting.
For those of us who want to start
In
writing.
fact, we submitted so many documents, they are not saying everything, not even away. So
Are you talking about ICA?
yes, I see. Sorry, yes.
ICA graduation. I think it's I'll update the team. Let me get the right date. Okay.
Yeah, that's
so
fine.
I'll inform earlier about that and then you communicate.
Okay. Thank you very much, Charlie.
Right.
Yeah.
Ada na ukamani. Nani meti muguda. Ya organize Zoom lecture.